CCIM really is the premier network of commercial real estate professionals in Northern California. It's been like that over the last 50 years. But we also network with property managers, developers, fund managers, attorneys, and really anyone in the business. And we represent the best of the best. So you want to be networking with us, you want to be tapped into our events and be a part of what we have going on. Now, brand of CCIM. Another thing I want to talk about is the actual designation and going through the process to get that. The CCIM designation is the highest designation in the land of commercial real estate. And there's a lot of reasons for getting that designation. As the slide breaks down some of the stats and figures, what I will tell you is in the process of getting your designation, not only are you going to learn a lot, but the people you meet at the classes that you take, you're going to do business with. And everyone that I know who's earned their designation has done a significant amount of business with the people they've sat down and learned with, because we're all putting significant time and effort to move forward our career. So that's what CCIM is about. You should be pursuing your designation. Now, another thing that I think is truly, truly important here is that, especially in NorcalCCIM, we have a significant amount of diversity. And you'll see by our leadership, as demonstrated here to the right, over the years, from people from all different walks of life, all different races, creeds, coming together for this idea of bettering the commercial real estate industry. And President Helen Chong has done an amazing job leading us through this pandemic. And she's put together a dynamite board to help support her. And the upcoming leadership behind her is looking, or in front of her, if you will, is looking really, really poised to continue this growth and, excellence and diversity, which is critical in our marketplace. And here's just a look at that leadership team right there. Look at it's a good looking leadership team. And they're very, very poised and focused on what they're doing. Done an excellent job during this pandemic, by the way. We've not skipped a beat, even though we haven't physically been there to see each other for quite some time. Now, we couldn't do this without our sponsors, and we have a lot of them. And Sensiba Sanfilippo Certified Public Accountants is a great firm. They're helping me out with something right now. I'm working in the Opportunity Zone space. Tim Tukowski's excellent. Our silver sponsors, Chicago Deferred Exchange. Teresa Monflugel is one of the best. Golden Pacific Bank, as well as a silver sponsor. And you want to make sure the people, again, this is a network. So get to know the people who are sponsoring. You're going to need them on a deal at some point in your career. So make the relationship now, so when you need them, you can get things done. Bronze sponsors are going to be Business Finance Capital, US Bank, IPX 1031, and Rubicon Mortgage Fund. The media sponsors, San Francisco Business Times. You got to make sure that you get that book of lists from San Francisco Business Times. Again, it's all about networking. Our monthly meetings are always the second Tuesday of the month, virtually for now. I think we're looking forward to getting back in person at one point in the future, but now it's still here virtually on Zoom, always the second Tuesday of the month. Deals and Drinks is the fourth Tuesday. Now we changed it from last year. It used to be the fourth Thursday, but it's now the fourth Tuesday of the month. So please join us on the 27th. Bring your deals, bring your listings, have a libation, and be prepared to network. There's nothing like being in person, but I will tell you that these meetings have been very productive and people have been closing deals as a result from coming to these meetings. So make sure you're there on the 27th. And as we talked about the designation, the Foundations for Success in Commercial Real Estate course is going to be on April 27th, 10 to 12 p.m., the 28th, 10 to 12 p.m., and the 29th as well at the same time. So you want to make sure that if you are serious about going and getting this designation, that you're there. And I'm pretty sure this is going to be well, I'm not pretty sure. I know it's going to be an excellent course. Make sure you're there if you're pursuing this designation. Now, this is something fun to talk about. We talked about getting together September 20th. September 20th. If you are a golfer, you need to be there. And if you want to see people get in person, make sure you are there at the Sequoia Country Club. We had a great time last time we did it. Come on out, network it with us, have some fun. September 20th, be there. All right, and then just make sure you connect with us online. We've got a Facebook group, a LinkedIn group, a YouTube station. All of our content is repurposed and put on the YouTube station. Make sure you're a part of that. And we've got 22 subscribers, guys. There's too much top quality content to only have 22 subscribers getting this. Make sure you subscribe to the station. Make sure you watch what's going on and you be a part of it. All right, membership, it's that time, $225 for associates, $175 for designees, $175 for candidates, and sponsors between $1,000 and $5,000 for your sponsorship. Join us, be a part of this power team, and make a difference in the industry while you're making money and learning a lot. Now, that brings us to today, our program. We're talking about commercial real estate lending. I'll introduce the panelists, and then I'll give each one of them a time to tell us about themselves and why you should be doing business with them. Stephanie Chung of BFC Funding, Doug Dransville, CCIM from Golden Pacific Bank, and Anna Duncan from US Bank. Anna, why don't you take it away? We'll go Anna, Stephanie, and then Doug in that order. Tell us a little bit about yourself and your business. Oh, looks like you're still on mute.
Sorry about that. Technical difficulties. Thank you, Steve. Anna Duncan with US Bank, and I work in the SBA division of US Bank, and I'm glad to provide these types of programs. And if anybody doesn't know, SBA is a program that we offer to our customers that are backed up by the government. It makes it a little bit easier for customers to qualify when we have a backup with the government. US Bank is a preferred lender, and what that means to you and the customers that when a loan is approved, it's already approved with the SBA. So we do our in-house underwriting for it. And then also, just to let you know, SBA can encompass many different things, including real estate purchases, construction and renovation, equipment purchases, working capital, inventory, and other business needs. Something else I wanted to let you guys know that US Bank also does provide a referral program. So if you know anybody that's needing any of these types of loans, please connect with me and I would be happy to provide that to them. And then also I provide flyers, and actually I just got a request this morning. Flyers with your business property that you're selling on it, as well as your name, and it gives you a comparison of the different programs that we offer, including the 7A and the 504, on what your deposit will look like for your customers, what their payments will look like, and it helps sell the building for an owner user building. Let's see what else. So it's a great program to qualify for owner user buildings, and again, it's flexible and it provides a lot of benefits to the customer and qualify better, especially during these times. And the great thing right now is that they've eliminated, until the funds run out, they've eliminated the SBA guarantee fee. So basically it's almost like a free loan to customers. And if they get it in time before the money runs out, the first 3 months of their payments are paid on SBA loans. So thank you so much for Steve for having me. But if anybody is interested, this is my contact information.
Thank you so much, Anna. I really appreciate that. And it's good to hear about the removal of the guarantee fee. That's really great for entrepreneurs, helping them to have a home for their business.
Right.
Stephanie, you take it away.
Sure. Thanks, Anna, and thanks, Steve. Anna, I've worked with Anna on several deals, and she's amazing to work with, so I definitely vouch for her. And I am Stephanie Chung with Business Finance Capital, also known as BFC. We're a certified development company, and we're licensed by SBA to approve underwrite, and close loans on their behalf through the SBA 504 program. So we always partner with a bank to provide this program, and that's why I've done deals with Anna at US Bank. We're one of the largest SBA lenders in the country and have closed over $1.5 billion in transactions over the last 8 years. Our product is pretty unbeatable. Our current rate for April is 3.07% for 25 years fixed and amortized. And we specialize in helping small to medium-sized businesses grow by helping the owner attain wealth through the ownership of real estate. And a little bit about my personal self. I've been in the commercial real estate industry for 13 years. I am chair for CRE East Bay Membership Committee, vice chair for CCIM Golf Committee, and a member of CBA, CREA, and ACP. And I'm also a certified SBA underwriter. I grew up in LA and went to college at UC San Diego. I moved up here about 10 years ago, and I currently live in Concord, California with my husband and 2 kids. My daughter is 5, my son is age 3. On weekends, I like to sing at church, and I started playing golf, getting ready for the golf event. And every day I am passionate about helping small businesses grow.
Well, thanks. Thanks for sharing about you, Stephanie. I think that's as a business, we're so cold, numbers, deals. We're still people. We got to know what we're dealing with, and I need to start practicing my golf so I can be prepared to swing with you guys on the 20th, because we got some players, guys, that come out there and play that golf. So thanks a lot, Stephanie. Appreciate that. And you're also a certified networker with all those groups that you're a part of. So I know you. Out of that. So thank you so much. Doug, take it away.
Good morning, Steve and Stephanie and Anna and everybody else. Appreciate you joining us this morning. My name is Doug Dransfield. I'm a Senior Vice President and Commercial Lender with Golden Pacific Bank, headquartered in Sacramento. Golden Pacific Bank is a boutique commercial bank. We've been in the Sacramento market since the mid-'80s. We're currently focused on primarily on financing multifamily and owner-occupied properties. We do participate in SBA's 504 program. We're also in the process of being acquired by SoFi. That's a fintech company headquartered in San Francisco. And this is public knowledge, so I'm not sharing anything inappropriately. It was announced about a month ago of this acquisition. It's going through regulatory process. As I mentioned, SoFi is an $8 billion fintech company. Will be their first bank. So they will become, assuming that the acquisition is approved by the regulators. Golden Pacific Bank the plan is for it to be a subsidiary of SoFi, and will continue to practice commercial lending. On a personal note, I'm a member of CCIM NorCal Chapter. I got my designation in 2016 and encourage any and all who are interested to pursue the designation. CCIM has a fantastic educational program that, and you'll find that the organization includes not only brokers, but also other real estate practitioners, attorneys, CPAs, lenders, and so forth. I've been in banking for a little over 30 years. I spent most of my time at Bank of America. I was in their commercial real estate industries group. And in 2014, went over to Zions Bank and did some C&I and SBA lending there for about 3 years, and then joined Golden Pacific Bank 3 years ago. I'm a graduate of UC Santa Barbara. I tried UCSD for 1 year, and it was just too serious of a school. I liked my weekends, and Santa Barbara was a much better fit for me personally. I don't remember a lot of those weekends, but that's another story. But I have a bachelor's in finance. I also have a certificate in real estate finance from UCLA. As I mentioned, I received my CCIM designation in 2016, and I'm also a licensed broker with the state of California, and do a little bit of consulting in real estate on the side. I have 5 kids. My youngest is 23. So, and he still lives at home. So I guess once a parent, always a parent. But I think that's about it in a nutshell, Steve. Thank you.
Well, thanks for sharing, Doug. I too don't remember some of the weekends while I was in college, and so I can relate to that. And then it's exciting to hear that you guys are being acquired by SoFi. I think that is an exciting thing. I'm sure that's going to elevate you guys to the next level. It should be a lot more business coming your way as a result of that. So I appreciate you sharing that with us. I think we'll see that as a growing trend in the finance industry. So speaking of finance, now that you guys have introduced yourself, let's get into it. And you guys out there listening, if you have questions, put them into the Q&A. And at the end of the around 10:50, we'll get to your questions, maybe 10:45, depending on how we get through this. And then we'll go through them. I'm going to ask you guys some, pretty poignant questions, guys, and give me your answers. And the first question is kind of 2 or 3 questions in one. And it goes like this. Are you seeing adjustments to your loan guidelines, specifically reduced loan of values and removal of higher risk property types like retail and hospitality? And the final one to that question is, where does multifamily fit in? So are you seeing adjustments to your loan guidelines, specifically reduced LTVs and removal of high risk property types, and where does multifamily fit?
Thank you, Steve. So first of all, we have not seen the removal of certain industries, and we have not seen a lower LTV for the credit guidelines. But if somebody has a COVID impact from last year, we want to see that they've rebounded, or we now are digging deeper to figure out how they rebounded and tell the story and have documentation. So it's a little bit deeper on us presenting it to the underwriters on what happened and make sure that they've rebounded enough that they can support the loan. So that's the important piece right now. And I don't do multifamily. I strictly do SBA, so I can't answer that question.
You're good. And thank you, Anna. Appreciate it.
Welcome.
So it's my turn. The SBA 504 loan is for owner-occupied real estate transactions only, with a maximum 90% loan to value, which is one of the highest loan to values in the lending industry. SBA has come out with looser guidelines in terms of refinancing, such as the secured loan to refi. It previously needed to be matured for 2 years prior to takeout. However, now it's 6 months. Also, previously, SBA required bank transcripts that proved the borrower was current for 12 months. Now that has also been reduced to 6 months. And also, SBA will allow refinancing even if the borrower has previously deferred their payments. However, prior to loan approval, borrower will have to be current on all their payments. So one of my deals, I've had a borrower had to pay like $30,000 to be current on all their payments before we were able to get his loan approved for the refinance. And SBA is allowing us to refinance previous SBA loans. However, we have not received concrete guidelines on that yet.
And something else really quick, the 90% guarantee on the 7A has been increased, and the government has provided that to us, which is a little bit helpful in a sense where we can get more qualified in that realm.
Mm-hmm.
That's good. That's a big deal. And do you, just as a follow-up with that, does it matter if it's a retail property or a hotel? Like for instance, for SBA, I don't know how SBA works with hospitality, but does the product type matter so much, or is it more just the business and the health of that business when you guys are underwriting for SBA?
For us, if it's a special purpose property like a hotel, we do ask for additional 5% down. But in terms of, if it's a higher risk industry, obviously, if the numbers support the business, then we are more than happy to look at the deal and get the loan approved. I do have banking partners that are a little bit more conservative and they have moratoriums in certain industries. So in that sense, sometimes I have to, kind of take the loan to maybe several different banks to get the loan approved on that end. And I have to have my bank partners have their loans approved for me to get close escrow and get the loan done.
And for you, Stephanie, multifamily, were you guys doing it, and if so, anything changed?
No, we don't do multifamily. Only owner occupied businesses.
Got it. Thank you so much. And Doug, weigh in.
Sure. So, Steve, let me kind of step back a second because I want to put my comments in context. And I'm not going to share anything that we haven't talked about before in different circles, but we've been through such a disruption in our economy this past year. I call it the Great Disruptor. There are four things that have happened that have really changed our economy. We have this incredible, especially in the Bay Area and the Central Valley, we have this great workforce, what I call workforce migration. Yeah. And we've seen that impact the city of San Francisco on one hand, and if I'll use multifamily as a bellwether, where we see a huge, significant increase in vacancies for multifamily in San Francisco, and we have seen we've seen a decline in vacancies in Sacramento, which has benefited from this workforce migration. The other three factors, there's a tremendous amount of liquidity injection that we're seeing by the federal government, state government to a lesser degree. We're seeing significant regulatory intervention. We can talk about restrictions on evictions, et cetera. And we have very low interest rates that were pre-pandemic, but still now are remaining low, at least short-term rates through the direction of the feds. So what that situation has done is it's for us as a commercial lender, and I'm sure our other, my companions here on the call, there's several things that we're looking at very closely. One is what I will call concentration risk. And by that, I mean, and I'll speak more to Golden Pacific Bank, we want to know how much we are lending in different markets. And we want to know what product types have we lent to in those markets. More specifically in our CRE exposure, we want to know where our greatest risk is: hospitality, retail, office, central business district versus urban versus suburban. And then, this third issue that I mentioned a second ago, interest rates. Pricing risk is becoming a bigger conversation point. I was and if you look at the 10-year Treasury, for example, a year ago in April of 2020, the 10-year Treasury was around 50 basis points. Now it's almost 160. I was on heard a call with CCIM where an economist, Marcus and Millichap, where their economist was projecting the 10-year Treasury at 3% a year from now. That's a very significant change in interest rates over a 24-month period. So all of those factors are definitely, go into the conversations that we have as a lender in all these different product types. It's impacted how we're looking at every single deal, both in terms of loan to values, in terms of debt coverage. We're looking more closely at the cap rates. We don't know in what direction our cap rates going to increase with interest rates, and so forth. So it's a very turbulent market right now, and so I'll leave it there at this point.
Well, and thank you for breaking down kind of what you see, specifically, when you're talking about multifamily with this workforce migration, because I'm seeing it, from San Francisco, seeing it in Oakland. I do a lot of business in Stockton, also doing some stuff in Sacramento. I think you're absolutely right. We've seen an increase in vacancies here in the multifamily space in the interior Bay Area pretty dramatically from where we were. And we've seen an increase or a decrease in vacancy, if you will, in the Central Valley and the Sacramento area. And I think that's significant. What I see in multifamily from lenders is a heavy scrutiny on the currency, if you will, of tenants. They want to know, are the tenants paying? And they want you to prove that the tenants are paying. So in deals that I'm working with, I'm preparing my sellers, and as a buyer's agent, I'm letting the sellers know, hey, lender's going to need to see proof that these guys are current. If they're not, they're going to need to see a detailed explanation as to why that is. So that's just a little bit in the multifamily space. Now, the second question for you guys is pretty quick. Are you seeing any unique alternatives emerge to what you're doing as a result of this interesting time that we're in? And we'll start with that.
Haven't seen anything. I mean, we always think of creative ways of making things happen no matter what, but I haven't seen any alternatives that we provide.
Good deal. And in terms of, and I would think alternatives being just any sort of solution to something that may be a challenge that is now something we didn't face before, but in this pandemic that we're seeing now. So I think that question, that's kind of the framework of the question. And, Stephanie or Doug, do you have any thoughts on that one?
Well, I mean,
Yeah.
I had gone over it earlier on, but we do have the refinancing alternatives because the guidelines have kind of loosened up on that. So I think I've kind of covered that part.
Yeah, thank you.
Yeah, what I'm seeing, Steve, is what's turning into a very frothy market, and by that, what I mean is that that I see, I look at as I bid on deals as a lender, I'll put out a proposal to a borrower who's looking at maybe 3 or 4 other lender proposals. What I'm finding is that in spite of this very disruptive economy that we've been in, I'm finding the lenders are becoming increasingly aggressive in terms of their pricing, more in terms of pricing and lesser in terms of underwriting. And that's when the lending market moves in this direction, it becomes a riskier lending market to lend into. So it's a much more heavily scrutinized, deals are much more heavily scrutinized now than they were 12 months ago, back in late 2019, early 2020. In terms of trying to find solutions to make lending easier, I'm not seeing that per se, but it is becoming increasingly competitive.
Yeah.
And that can be very dangerous when that happens. I mean, look at we're a business, and people forget that. I mean, I worked with B of A where they had over 100,000 employees to a company that has 30 employees.
Yeah.
I work for a small business, and so I need to be profitable, and so it becomes a much more complicated game lending industry right now until things start to stabilize, and they're not stable at all right now, in my opinion.
Yeah, absolutely. And one thing, thank you guys for that feedback. And one thing I've seen emerge as kind of an alternative on 2 deals I was working on where tenants were not, and this is multifamily, where a couple tenants were not paying, and there is this eviction moratorium that's in place. So I've seen a couple lenders say, hey, look, we can make the loan, but we're going to need additional capital on the sidelines from the borrower. We'll talk about that in a few questions. But I think that lenders have cheap money. It's a business, like what you're saying. It's competitive, but they're from what no one wants to take that extra risk, especially where there's people not paying, and not knowing when we can evict. So, some extra cash on the side is certainly, possibly an alternative to getting a deal done. And next question that we have for you guys is, are maximum loan amounts being changed? And I think this is an interesting question. I know lenders typically would like to lend more, but right, LTVs, but what are you guys seeing? And we'll start with you, Anna. Are maximum loan amounts being changed?
No, but in a situation, like I had one situation where the customer had some weakness, and then and there was a point where if he was under a certain point, then it would be better for him. So I was able to, and it was off by like maybe 20,000. So it wasn't a huge difference for him, but we were able to like approve him for this dollar amount versus that dollar amount because it fell into a different category, so it was easier to qualify basically. So I mean, I've had creative ways of making it happen. That's what we end up doing, but nothing is officially changed. No.
That's good to hear.
I'll speak a little more to multifamily because that is primarily what we're lending in right now at Golden Civic Bank. And I'll qualify this because of our size, we only lend up to $2 million per transaction. So by that limitation, we're focused on smaller apartment projects and typically B or C class properties. Heavy on the workforce with some subsidized rents in there as well. So in terms of your question about lending amounts, the amount that we're lending has not changed. However, I would rather make a loan with a little less leverage and a little better cushion on the debt coverage. My policy may still be where I'll lend up to 70% loan to value. And I want to see a debt coverage of 1.25 to 1 on the property. With some of the weakness in the market, I'm probably going to look for a little more equity and a little more cash flow coverage on the DSCR of maybe 130 to 1 or 130 times. And so, I am going to be a little more conservative, but again, we're a boutique lender, so we look at every deal on its own merits. And we look very closely at the tenant mix in terms of the occupancy, the historic occupancy. We want to know if any of the tenants are not paying rent. And I have a property right now where a project I'm underwriting where 2 of 8 tenants are actually receiving some rent subsidy through. They're receiving 80% of the rent coverage through a COVID relief program. We're okay with that, and the reason is that this COVID pandemic we're into, we believe, is coming to an end in the next 6 months in terms of the level of vaccination, in terms of the state reopening businesses and so forth. So we've taken the position that some of the weaknesses in the tenant cash flow is a short-term issue, not a long-term issue. And for that reason, where in the past we considered requiring reserves, if there was some COVID tenancy issues, we've stepped away from that. Reserves have some issues of their own that you have to be very careful of as a lender. So we don't require reserves, but we do if a couple tenants, in this case that I mentioned, we'd like to get some documentation from the seller so we can document our files that those tenants who are receiving assistance are in fact engaged in that program.
That's good to hear that program is actually working, for lack of a better word. And it's out there, and the lenders see it and are okay with it. So that's really good news. And Stephanie, any thoughts on that? The loan amount?
Well, maximum loan amount for SBA has always been and still is 90% loan to value, which means the borrower only needs 10% down. The only situations where they need to put additional money down is when they're a special use property or when they're a startup. So SBA considers a business a startup if they haven't owned it for more than 2 years. So, that's when the loan amounts change and, loan to values change. And there are some other changes, like Anna had mentioned earlier, with the extension to the CARES Act from 2020. SBA is offering 3 months of debt forgiveness and fee waivers for loans approved starting February till September of this year. So that 1.5% CDC processing fee is waived, along with the 0.5 third-party lender bank SBA participation fee that's also waived. So it's a good time to get an SBA 504 loan right now. The only thing is currently SBA is handling over 700 loans consistently. So turnaround for approvals are at 2.5 to 3 weeks. So we're right now trying to collect the complete file to submit the loan application sooner, and we order environmental appraisal reports right away to mitigate any long SBA turnaround for approvals.
Well, it's great to hear SBA stepping up. And I think they really have done a great job administering these PPP loans and business loans and really stepping up. So I appreciate and applaud that. For a startup, is there a amount of this? Say, I think it looks like 90% minus whatever, however you guys underwrite that. But are you saying for a startup, look, you guys can only go for a $5 million loan or $2 million loan, or you can't go over 10 million? Is there a cap for a startup company who is seeking this type of loan?
So it's interesting because it's not necessarily a startup like the tech companies use the word startup. For us, it's more like there's an existing business, like a flower wholesaler or something, and then another party wants to purchase that business. And so, along with that is the real estate. So in that sense, like, because they have not owned that current operating company for 2 years, it's considered a startup because they're kind of taking over this business. So the individual, lacks that 2-year ownership experience. That's why we need that additional 5% down.
Got it. That makes sense. Well, I appreciate that answer. SBA has done a heck of a job during this pandemic. I have to say, and thank you guys who administer those loans, because we need you in this economy, So we'll move on to the next question, which I think we've kind of all talked a little bit about, but let's dive into it. Is underwriting getting more conservative? Give me your thoughts on that one.
For our purposes, again, it's telling the story. I mean, they're getting conservative and making sure if there was any kind of COVID impact, we have to tell the story and provide documentation to back it up. If we can't provide documentation that they have rebounded and we can show that they're doing well right now, then that makes it much harder. I mean, it's not that they got conservative; they just need like if our write-up used to be a little bit more simple, now it's like intense. So that's the part that I think that the difference of not, in a sense, conservative.
And for us too, our underwriting has not been more conservative. However, we do ask COVID-related questions similar to US Bank. We look to see if the pandemic has affected the company's revenues, customer demands, operating hours, and if their suppliers are raising prices or are back ordered. SBA is requiring the CDC to provide information that the businesses have had no adverse change. So this is another thing that we need to do. We need to submit cash flow even after loan approval to just ensure SBA there's no adverse change to the business before we can fund the debenture. So, but I am seeing more bank declines for loans. So I'm having to find new homes for several deals that I had worked on this past year.
Are those just not meeting the criteria, or the bank just saying, we don't like that product type, or we're just a little nervous about this, or or it's just random?
Yeah, some banks, they definitely have their appetite has changed. So, pre-pandemic, maybe they would have jumped on a deal. Now they're looking at with more scrutiny. So if they don't feel comfortable with the deal, if they feel that the borrower doesn't have enough liquidity, or maybe just the business is a bit of a high risk industry, initially they might say, hey, I'm going to look at the deal, and then, you know, weeks later they're like, I'm going to decline this loan, and then now I have to find a new bank to participate in the project with me.
Got it.
And twofold, there's been some loans that other banks have declined, and we were able to approve because of us looking back only 1 year and not 2 years like they require. And then there's one loan that I can think of actually that I work with Stephanie directly, and his numbers that he provided initially were certain numbers, and then by the time, you know, because taxes came along, and by the time they came along, it was a different number, and so I couldn't help him. But in working with Stephanie, and she's done an amazing job too, is she was able to find him a different home. So that's where Stephanie and I can work together to figure out if this deal is going to work or not. And then she's come to me, I guess, with deals that other banks have declined, and I've been able to approve. So there's, you know, in knowing each other what we could do, we help each other in finding homes for them.
Yeah, and that particular borrower, I actually had to take it to 3 additional banks and finally got a conditional approval this morning.
Nice.
So it was a wild ride for that one.
Well, I think I'm glad that y'all brought that up, because in this high-tech age that we're in, it's still a people business. And you guys in the finance space, you know, what you just demonstrated is that ability to be nimble, to think on your feet, and the importance of having a solid network. And I don't think that goes away no matter what technology comes out, is having that solid network where you brought it to these banks, they didn't approve it, but you brought it to Anna over here, she got it done. That's the direct relationship correlation to your network. And that's why this is, you know, very, very important what we're doing here this morning. And so I hope you guys listening heard that. Make sure you build your network. And what are your thoughts on that question, Doug?
You know, I think I don't like the word conservative. I would rather use the word cautious right now. I think that, you know, and I think to Stephanie and Anna's point, lenders in general are more cautious in how they're looking at how they're analyzing a potential loan. You know, I think our general underwriting criteria has not changed. However, you know, to their point, you know, we look very closely, increasingly much so, on the sponsorship of the deal. So we are also testing what's called a global debt coverage. We're testing the global cash flow, the global debt coverage, which is your, you know, the total income and the total debt of the borrower, both personally and business. And so, you know, we want to make sure that you know, that there's longevity in spite of turmoil. But I would say on the for our bank, you know, we had been very active in the SBA 7A market. We are not at this point in time, and that's a reflection of from what we're seeing in the elevated risk in that specific segment. And let's speak for a minute about restaurants. Restaurants, from my experience here at Golden Civic Bank and prior banks, restaurants are big, you know, great users of the SBA 7A program, as it should be. And the restaurant, we've seen what's happened to the restaurant industry for all of us here in Northern California, from San Francisco to Sacramento to the East Bay down the peninsula, and how devastating the SIP.
Looks like we're losing Doug.
Your fast food rather than full service, definitely. And so that has, for our bank, you know, we have a full plate of restaurant loans that we're taking care of. And so it has changed, and I think every bank is going to have its different strategy and how it positions itself. And but that, that's a good case in point where, from our experience, we have consciously decided to focus more on other product types that we feel are a little more recession proof or resistant right now.
And a term I've been hearing, you said recession proof. I've been hearing COVID proof. So from lenders,
right,
and definitely seeing just everyone looking, especially in the investment property space, or office, multifamily, and retail investment properties, the global cash flow from, as a broker's perspective, when I see lenders there, that is becoming very, very important in the investment property space. Now, are you guys seeing more reserve requirements to cover future payments in your underwriting right now? More reserve requirements, and any trend on down payments? I think we've kind of covered this, but I think the reserve requirement thing is something to talk about. I'm certainly seeing that in multifamily. You guys seeing that?
In the SBA world, there was no increase in reserve requirements. I mean, unless it was like a restaurant in sense but we had that in place to begin with. So that hasn't changed. But if somebody has more working capital or liquidity on their personal side, that's going to help them tremendously, especially during COVID. Absolutely. No doubt about that.
Yeah, I agree with with that. The liquidity becomes a big factor. For our bank, we looked at reserve requirements, but never implemented that as a lending tool or requirement. So that's never been an issue for us.
So for me, like Anna said, SB does not require a reserve for our deals. However, I've noticed that there are some of my banking partners that are asking for 3 to 6 months reserves when they had not done that in the past. So one of my deals, it was a machine shop. I had to take it to a different bank because the initial bank, they declined the loan. And the second bank said, we can do the loan, we can close, but the borrower's gonna need 6 months in reserves until they file their 2020 taxes. Once the 2020 taxes are filed, we'll let the reserves go. So that was kind of a creative solution to get the deal done.
There you go. I like that.
Yeah,
real creative solution.
Too, that 2020 taxes were actually better, and we were required to have them to file for it before we could even close on the loan as well. So I mean, and again, going back to your people factor, it is important to us to make sure that we help them make their dream come true. Is if we find them another home, like Stephanie, like where I work with Stephanie, or if we find them an alternative in their financing.
I think it just, like it requires thinking on your feet, and I do, but now it seems like more than ever, having cash in the bank is going to help you get a loan. Because they're looking, certainly in the investment property space, they want to see a little bit more reserves. At least that's what I'm saying. Now, that being,
Steve, if I just inject one thing, underwriting is, in my opinion, is an art, not a science. If you want to, and there are lenders that do this, and I'm not speaking about my colleagues here, but I do know of lenders that on the small loan size, it goes through a processing center and it has to fit all the boxes, and if it doesn't, it gets kicked out. So I think that's probably I just think at the end of the day, you just have to look at every deal on a case-by-case basis to see if you can make it work or not.
Yeah, and great point on that. It's a case-by-case. Every lender is also a little bit different on it, and so I just think as brokers, investors, we got to prepare our people to be ready. For that.
Keep in mind, lending is about risk taking. I mean, there's the only loan that I know I'm going to get paid back without question is a cash secured loan. No risk to that.
Right.
You stop making your loan payments, I'm going to take your cash and pay off your loan. So anything away from that, there's an element of risk. And so, the art of lending, the art of underwriting is trying to find that balance between that risk and the reward.
Yeah.
You're always looking at the risk element of a deal. You just want to make sure that there are factors in place to mitigate that risk, because as I give you my money, I want to make sure you're going to pay me back.
Right.
And if you want my money and you don't want to pay me back, then it ain't going to work.
No.
And so, and that's where you just have to, and that's the fun of what we do. All three of us, I'm sure Anna and Stephanie would agree. If you like lending, if you like getting into it, it's kind of it's a cool industry, because you're really helping people. You're giving them money and capital to make their business work. And it's a personal business too. It's a very personalized business. You're talking to people, you're seeing their struggles, you're learning about who they are, and you just try to look at all these different factors to make sure that, in spite of the possible risks out there, that it's going to be good. It's going to be a win-win for both the lender and the borrower. And that's where the art of doing this lending is. It's everything. Every deal is a little bit different, and you just work with those differences to make it happen.
Yeah, and I'm glad you're the first person I've ever heard to say underwriting is an arts, but
it is.
I'm glad to hear you say that. Now, we're a little behind, guys. I don't see many questions in the Q&A, but we got a couple more questions that I want you to answer. We maybe go quickly. I know none of you guys here are private money lenders or hard money lenders, but historically, these lenders are more nimble than conventional lenders. Has this situation given them an advantage, if at all, in these times? And I know that's not what you do. Just quickly, your thoughts on private lending.
I've gone to private lenders and they've helped me in situations where they've given the customer a temporary loan, because I've figured out a creative way. Otherwise, I wouldn't be able to help them. So they're very helpful in this time.
For us, private money lenders are definitely historically more nimble than conventional lenders. However, there are secondary market lenders and community banks who are hungry and want to lend. So I've been able to find homes for my deals through them. Their interest rates are in the low, mid to high fours. But in some instances, we can close escrow with a short-term hard money loan, and SBA can take out the loan after close of escrow.
That's great to hear. That's great to hear, because I know a lot of deals get time crunched, and that's where hard money can come in and help save it.
Yeah,
I work with a lot of mortgage brokers and who are having me look at deals. I also have a couple. I have a hard money lender who I refer people to frequently. I mean, my approach, and I think all of our approaches, if we can't help you, let us find somebody who can. Yeah. It's not me versus the world. It's me trying to be a part of this industry. And the beauty of the hard money lenders is that they have access to private capital, private lending, private funds that are not as that are not regulated, and so they're able. You pay a premium for that service, but it's access to capital, and that's the name of the game. So I if I can't do a deal, yesterday I had a broker call me and on a deal. It was a single tenant, credit tenant, single tenant occupancy. I couldn't do it. I called. I said, "Here's actually, it was another banker who I know pretty well." I said, "Here, call my friend Steve. He might be able to help you." It's just again. So I think hard money has definitely a place. There's a ton of liquidity in the marketplace on the sidelines, and that gives great opportunities and resources for people from a non-banking finance standpoint, for an unconventional financing. So I think they definitely have a role in place, and will continue to do so.
Absolutely. Okay, and we'll move to the next one. Now, this is an interesting question. Walk us through a deal where you had a commitment to fund. So the lender or your bank has committed, but it didn't close. Have you guys experienced any of that during this pandemic?
I do have one right now that I'm working at, but it has to do with the environmental issues. We ran into where it was requiring a phase 1 and a possibly phase 2. And I thought it went south, and I just looked at my phone real quick, and it's going to move along, and they're going to do the phase 2. But that, those issues come up all the time, and it keeps our job on our toes, because we have to figure out, creative ways of making it happen. If some situations like this week, there's nothing I can do. It has to have a phase 2.
Yeah.
But yeah, absolutely.
So for me, I have not had a deal where we didn't close escrow after SBA loan approval. I've always been able to find a home for my deals. However, there is one deal where we were not able to fund the debenture after we closed escrow. So the situation is that this operating company is an Indian catering business, and they provided food for weddings and large parties and tech companies for lunches. And obviously due to the pandemic, the operating company's revenues just dropped drastically, and they had negative net income. And this project also included construction, and the borrower, when they first did their initial inspection, the inspector said you need to do X, Y, and Z to this property, and it just added significant cost to the original TI amounts. So for SBA, in order for us to fund the debenture and take out the bank's bridge loan, we need the TIs to be completed. In this situation, they didn't even start TIs. They were like, we don't have the money. So we're hoping that, the business will start turning around for the borrower. The revenues will start growing, and hopefully they'll complete their TIs and we can take out the bank's bridge loan.
Good story.
Steve, you asked a really good question. I'm seeing deals that are becoming a little dicier. I don't think we need to get into the weeds right now, but I'll tell you, my concern is, and we'll speak to multifamily. I don't know how the market is going to look 6 months from now in terms of vacancies or cap rates. For example, I would say most of the appraisals that I've seen the last 3-4 years, the vacancies have been very low. 5% seemed high.
Yeah.
Now, I think, how do you appraise a property in San Francisco right now? 5% vacancy? I doubt it. Yeah. Is a 3.5% cap? Is that still a reasonable cap rate? I doubt it. We're in a transitionary market right now. So I would say that I haven't seen too many deals that haven't worked. But I think going forward, we're going to see more disruption in our market, and I think it will start to surface itself on appraisers. Yeah, I've been through. Some of us have been through. I think many of us have been through several recessions, and typically what happens when the market peaks in terms of real estate values, that's when things start to change. I'm not quite sure where we're at in the cycle.
Yeah.
In multifamily, it's still relatively strong in most areas, but I think we're going to start to see some changes, and it will surface itself in how appraisers are looking at the world.
Yeah. Yeah, and we're right at 11. We had a follow-up question to say, hey, conversely, is there anything that you were able to step in and say? I've got one question in the Q&A I want to get to real quickly. If you've got anything, a story where, it was turned down and you were able to save it, that'd be great. And if you do, make it super quick, and then we'll get to our Q&A, because we definitely have a couple.
Absolutely. That's one of the ones that I was able to save is they were trying to refinance a loan, but there's certain criteria that SBA requires for refinancing a loan, and it didn't meet that. But I was able to figure out a way, but they had to refinance it. I had a hard money lender come in, do a temporary loan, and then I was able to go in and refinance it. So that made the customers super happy. It's buying out a partner that they don't want to deal with anymore.
Right, right.
I had a multifamily deal where the expenses were high and they were really, it was the expenses that were dealing with capital improvements. So I was able to get enough documentation to show that the actual expenses, recurring expenses, were lower than the historic expenses, which based on some documentation provided by the borrower, and that was able to save the deal. So yeah, it's very nuanced, but you just look closely at the details and make sure you have the right story to tell.
So for me, I had a borrower who was a food distributor. She supplied vegan fried chicken to restaurants and grocery stores, and they were trying to buy a property in Oakland, but prices were too high, so they started looking in San Diego. The bank at the time said, "This is a different market for you. We're not going to lend on this deal." And the borrower felt like, well, we're distributing. It doesn't matter where we are. So I was able to take it to 3 additional banks. They had projections, 1 full year of strong cash flow, strong interim financials, and we're able to close with a community bank in San Diego. And she called me with tears of joy. She was so happy. And she's a Black female business owner, and my heart was just bursting with joy once we closed escrow. So my passion is to help small business owners along with minorities and other women-owned business owners. And I understand small businesses are like a baby to these people. So, I'm more than happy to help them. I'm not only a lender, I'm someone that can be a voice of reason, calm, especially during their first real estate transaction.
Yeah. And that's amazing to hear all of your stories, because look, sometimes as brokers, investors, we feel like lenders are looking not to do a deal, but it's good to hear stories of people such as yourselves who just mapped out making a deal happen when it looked like there was no way. I'm gonna have to try some of that vegan fried chicken. I don't know how that works.
Good.
They must have. It must be the chickens without the bone, and maybe like the chicken strips or something. But you made it happen, and that may not have happened if you didn't do that. And huge part of our economy is what you guys do. So kudos to you all. Really, really appreciate those stories. It's 11:03. We do. And real quick, I'll give you one. I was in the middle of a deal. We were about to close, a week away from close. Bank issued a commitment letter. I won't say the bank. And then they committed. A week later, they said, "Hey, we'll do the loan, but we're not doing it at 65%. It's 55%." That was a $250,000 difference. But then we had, there was a bank, Citizens Bank, who stepped in, and they got the deal done at 65% LTV, and they closed it 39 days away from they took the file. So guys, there is hope out there. You've heard it here. You've heard some of the solutions. So, this market, whatever's going on, there's always a way, and I think that's, what we're talking about today. And you've heard it from some of the experts. So I'll go to the Q&A, and we've got one here from Dan Del Real. What's up, Dan? How you doing? Dan says, Doug mentioned the M&M forecast had the Fed rate going to 3%. Did I hear that right? In 24 months, if that happened, would that impact mortgage rates? You guys can delve into that. The 3%, huh?
Could you froze up, Steve? Could you repeat the question? At least it froze
guys.
up on my end. I'm sorry.
No problem. It said Doug mentioned the M&M forecast had the Fed rate going to 3%, and he puts in parentheses. Did I hear that right? In 24 months.
No, that was a comment. Yeah, that was a comment by one of the participants. That's not M&M's projection. That was a comment by one of the participants.
So somebody kind of a rogue extremist, maybe, right? Hopefully.
I've heard the same concerns from CCIM's economists.
Well, I think at some point you can't have interest rates this low forever, but 3% in 24 months, right, from wherever we are now, that would seem extra extreme.
Well, I think, the Federal Reserve Chairman Powell has, Yellen's Treasury Powell has indicated from what I'm seeing that the federal government intends to keep short-term rates the discount rate that they charge the lenders low through 2022. But the 10-year Treasury is not driven by the feds unless they start buying bonds, and I'm not sure they're doing that right now. So again, it comes down to inflationary pressures due to the influx of liquidity, primarily by the federal government.
Yeah.
So if somebody can tell me with a surety where the 10 years going to be in a year from now, let me know, because I'll know what that's going to impact my investment decisions.
Yeah. It's
a wild card, but the rates are not going to. I don't think the rates are going to stay. I don't think it's going to be 150 a year from now.
Yeah.
I'll bet anybody a lunch through a McDonald's drive-through, it ain't going to be 150. I think today was 156, the 10-year. I strongly doubt it's going to be flat for the next 12 months. And I don't think it's going down either. That's my own personal opinion.
Yeah. Guys got any feedback on that question?
I don't. I do apologize.
Other than whoever mentioned that 3% on that, be interested in where they got that, because that would be crazy in 24 months, and I hope we don't see that. I think we all think that there'll probably be an increase in rates here down the line, but 3% would be crazy. I think to go from where we are in 24 months. Now, I don't see, if you guys out there, if you have any other questions, that was the only question in the chat. We can hang out for a couple minutes. We have a hard stop at 11:15. One question I wanted to ask you that wasn't on the list of questions is, what do you guys think about debt coverage ratios and where they're going? I heard you mention 130, Doug, which is kind of extreme in the Bay Area. I haven't seen a 130 deal in the Bay in a minute, but what do you guys think DCRs are going and where they are right now? Do you see the banks expanding those anytime soon?
Well, for SBA lending, we actually go to 105 to 110, and then sometimes globally and we want to see the business cash flow at 115. But we have situations where as long as we're at 1-to-1, we could take projections into consideration. So it's a whole different ballgame because of the government backing up the loan.
Similar with what Anna said, we do the same thing as well. We do definitely add back rent. We add back excess owner salaries. So, and maybe also right now with COVID related items, a lot of offices had to buy, office supplies that prevented, I guess, the spread of COVID disease. So, they had to get plastic barriers, they had to get additional masks, things like that. We can add those items back as well.
Good.
So the debt coverage question, Steve, the part that nobody really focuses on is the underwriting interest rate that the lender is going to use in calculating that debt coverage ratio. And so I mentioned 130. I think that's I do deals at 125, and these are conventional. SBA is a different animal. They're high or highly leveraged. By definition, a borrower who's getting an SBA loan is going to SBA because they cannot qualify conventionally. And typically, lower equity injection drives a lot of that conversation. That's understandable. So you are going to have higher loan to values, lower debt coverage ratios. So on the conventional side, I think, I like to say, I want to look at a property. I want to see a debt coverage ratio between 125 to 130. And it's going to vary depending on, I'm going to underwrite office a little more cautiously, than I would an apartment project. Because I think there's higher risk with office right now at this point in time, or retail for that matter. And with retail, what kind of retail are we talking about? Talking about strip center? We're talking about a single tenant occupancy. So a lot of different, is it community? Is it a big box? So each of those different sub-product types are going to drive the conversation a little bit differently. But I think in terms of multifamily, we're comfortable with 125. But depending on what's going on, depending on the size of the property, how much cash equity, the leverage, all those factors, I may want to see a higher debt coverage ratio than that. But typically the loan to value with low cap rates, there's always been a little bit of a disconnect between loan to value and debt coverage. Yeah. And I really rely on debt coverage because it's cash flow that pays back my loan.
Yeah.
Not leverage.
Well, yeah.
And so,
especially in the investment world, right? I mean, when somebody
right,
saying, hey,
exactly.
I'm investing in this property, then you got to take that into account. I asked that for you guys as a broker, as somebody out here feet to the street and just seeing it. And I could see that being a response from lenders and saying, hey, we just need a 1.25. Like in the Bay Area, 1.25 is like, oh. So when you say 1.3, that's it's going to take a lot of people out of the game, at least in the Bay. But it makes sense from a lender's perspective. And with that being said, guys, that I don't see any more questions in the chat or the Q&A. It's 11:11. We're going a little bit over, but I think it was well worth it because you guys are giving us really expert content. And for y'all listening, I hope this was helpful as you push forward in your business, whatever that might be. That there's going to need to be some creative solutions at some point in time. And all three participants were able to tell you some of that. Some of their success stories, how they saved some deals. And what Terry Shore says, okay, contact info is on our website. Make sure you reach out to these folks, do some business. Make sure you network. You heard here from the experts how important your network is in terms of when the heat is on and you got to get a deal done. You might have to take the deal to different, banks. And as brokers, as investors, as principals, you guys need to make sure that you have a strong network. Therefore, become a part of NorcalCCIM, engage with us in our events, and be a part of it. April 27th, next Tuesday, Deals and Drinks. If you're a broker, you're an investor, bring your deals, have a drink, build your network. That's how we're going to do more business. That's how we're going to, elevate our industry and make sure that we're leading the path and not just observing. And, also wanted to say that this recording will be available on our website. We posted, I said website, but probably on YouTube. Watch it, share it, get the information out there. We need to work as a marketplace in terms of raising the understanding of what it takes to do business in this environment. It's not easy, but it's doable, and we're going to get it done. So that being said, let's wrap it up, guys. I hope you guys all have a great day and look forward to seeing you out there, pretty soon. And the golf tournament, we're going to get together again the 20th of September. So, get ready for that, y'all. Work on that swing.
Will do. So,
great day.
panelists, I wanted to do a screenshot. So if we can just all smile, 1, 2, 3. All right. Well, have a wonderful day.
Thank you so much. Have a great day, y'all.
Thanks, Steve. Thanks, everybody.
Thank you, Terry.